We're also gearing up for tomorrow's highly anticipated Federal Reserve decision. The central bank expected to raise interest rates for the first time since the financial crisis in 2006. I want to bring in Savita Subramanian right now. She is Bank of America Merrill Lynch head of quantitative and equity strategy. Savita, great to see you.
Great to be here.
Your expectations on the Fed?
Well, we think they're going to go. And I remember being on this program the day after they didn't go in September. I think they've basically run out of excuses. The thing to watch is the VIX. So one thing I've noticed is that the Fed never tightens, never starts a tightening cycle with the VIX above 24.
That's the volatility index.
The volatility index. So watch market volatility, but I think that all signs are green at this point.
Wait, hold on. Isn't the VIX only like 25 years old? And the last time they tightened was like 10 years ago. So I don't know that there's that.
Yeah, there's not that many
historical instances to actually compare it to. But Savita, what I was just taken aback by was I was just checking on the Fed Fund futures, and right now they're pricing in a just under a 79% chance of a rate hike. So the probability is high that this is going to happen tomorrow. But the probability was 85% last week, so it's been coming down into the announcement. And meanwhile, Wall Street analysts, more than 9 out of 10 Wall Street analysts are saying it's going to happen.
Right.
So it's almost like the market's setting up possibly for a little bit of a surprise here when you consider that 1 out of 5 in the Fed Funds futures is pricing in a surprise. So
that's a great point. I think you never say never. I mean, in September, half the market thought they would go, half the market didn't, and they didn't go. So I think, you know, it's always it's never a foregone conclusion.
But you think the market's priced in a hike at this point?
Yeah, I mean 80%. I think it's a lot higher than we were in September. So if they do go, which I think is kind of a foregone conclusion, at this point, I think the bigger question is what happens next year. So how does the cycle look next year? We're looking for 3 hikes next year. So we get to 1% on short rates by the end of next year. That's our house view at Bank of America. I think, you know, if they start talking down the trajectory, that could be a positive for risk assets. If they remain kind of hawkish, that could be a negative.
So if they talk about an economy that is slowing and it's really all about the data, you think stocks rally?
I think they could do okay, yeah. I mean, I think that it's a different set of leadership that you get if they're dovish or hawkish. So if they're hawkish and they start talking about, you know, the economy being solid enough to continue to tighten, I think what you want to buy are synthetic cash instruments, cash-rich companies. Because if you think about it, cash goes from being 0 yield to yielding something.
Oh, right. Yeah, sure.
And, you know, all these tech companies that have been sitting on piles of cash have seen no re-rating over the last cycle. All of a sudden, you've got a bid on cash, and I think that changes the dynamics a little bit.
Well, I think you've got one of the reasons we don't have a higher probability is it is kind of a head-scratcher right now when you look at them raising, and yet at the same time, Citibank forecasting a 65% chance of a recession in the next year. I think JP Morgan came out and said a 76% chance of a recession in the next 3 years. And at the same time, we're raising rates because the economy is so strong. It's kind of conflicting, so no wonder there's some confusion out there.
Right, indeed. So, I mean, I think we're literally off the grid in terms of comparable periods, right? I mean, we've never been at 0, so this is kind of a big deal. But I think the idea of going from 0 to 25 is going from emergency level, you know, super easy monetary policy to a path to normalization. And I think that might not derail the market. Where you don't want to be, and what we're already starting to see sell off, is credit. And I think that's the #1 risk to investors. Anything with a whiff of credit sensitivity, stay away. And here I mean small cap stocks, I mean emerging markets, credit or equities. You know, these companies need capital to grow, and that's where you're going to see more pain.
And we saw that obviously after Third Avenue closed its shop. Everyone's worried about credit funds. We're seeing a number of credit hedge funds and mutual funds close shop.
Exactly.
Isn't it interesting that was a mutual fund that liquidated?
Yes, exactly. So it's happening everywhere.
Third Avenue. Yeah,
exactly.
It wasn't, you know, ETF. It was a mutual fund.
Well, let's think about, too, what happened with Dodd-Frank and the proprietary trading restrictions. That we do not have a market that is anywhere near as liquid as we had for the last financial crisis, and that was earth-shattering. This time, we're in a lot more difficult situation when it comes to these challenged credit markets.
Right. Liquidity.
We have no idea how it could happen this year.
Paramount importance. And you've seen, again, liquidity and credit are the 2 things you want to pay attention to. Credit sensitivity, stay away. Illiquid investment vehicles. We, the investment banks, can no longer provide that liquidity to investors, and that has totally changed the game.
But
for
what
investors.
you do like is these cash-rich companies. I don't know if you can name specific companies, but any sectors that it's a good actionable idea. Any sectors?
Yeah, absolutely. So big cap tech, poster child for cash-rich, super cheap. Nobody likes big cap tech companies.
Like an Apple. What do they have?
Exactly.
100 billion plus in terms
They've
of cash.
got
And it's a cash
massive
machine.
piles of cash. They're generating cash. I mean, these are companies, even if it's overseas, the cash is denominated in short rate vehicles. So if the Fed funds rate goes from 0 to 1, that's a reasonable yield you get on this massive
And it also helps in
cushion.
case of a credit crisis. When you have these cash-rich companies, then you don't have to be so dependent on the credit markets.
Interesting point. So the only sector that didn't lose earnings over the credit crisis was technology, because it has no debt. So that I think is exactly the right way to think about it.
And you've liked tech for a long time. Give me one other impact for the broad public out there, because we talk about how important the Fed raising interest rates is, but I want to drill down on what might happen to people. I mean, will their mortgage rates go up, and their car loans, and their this and their that? I mean, interest rates going up a quarter point to the Fed has what kind of impact for the average guy and gal out there?
Consumer. Yeah, I mean, it's again, we're off the grid. I don't know if 25 basis points really changes the equation. Like, do I start saving more money because I'm making 25 bips on a CD? I don't think so. But, you know, I guess the good news is consumer balance sheets are fairly healthy. They've paid down debt. They've paid down credit card loans. They haven't spent this big windfall from lower oil prices, which we've all been waiting for.
Yeah, that's a head scratcher.
So, yeah, so I think that there is pent-up spending power from the consumer segment. It all depends. I think oil prices falling too low could be the big negative for consumer confidence, for corporate confidence, and that's what we've seen so far. Is the market has been very correlated with the price of oil. As a risk barometer, I think that's the metric to watch.
I agree. I think the knock-on effects are real. Savita, good to have you on the show today.
Nice to be here.
Thank you so much. Savita Subramanian, and that is Bank of America Merrill Lynch quantitative strategist there.